Hi everyone, and welcome to the InvestSMART Bootcamp webinar. And this is week 3, which is covering off the module 4, which is investment strategies, one of the more exciting modules in the bootcamp. I'm Tom Wilson. I'm one of the product specialists here at InvestSMART, and I also look after the bootcamp program as well. So let's get started. So as always, just a disclaimer there. So we don't provide any personal financial advice. It's general only. So definitely keep that in mind as we go through this. So let's start with what's the purpose of this webinar, just like the other ones. Basically, it's always to cover off any additional questions that you might have coming up from the learning material. So as you're going through the bootcamp modules and you find something that doesn't make sense or you needed a more in-depth explanation, or might even have some kind of supplementary questions with it, this is the best avenue to ask. And you don't have to attend the boot camps. You can actually register for them each week and submit a question that you'd like covered. And we do have some for this week already submitted, which is great. And we'll cover them off and you can watch them in your own time when we upload them into the course content each week. So just remember that it's no financial advice given. If I do get a question that is, I guess, personal financial advice orientated, I'll try and rephrase it so it can help everyone else. But if not, I'll contact you after the webinar finishes, usually just by email. We need to stick to the course content. So this is module 4, investment strategies. So we'll try and stick mostly to the content covered off in this week. If we do have questions that come through that are perhaps better for a previous week or an upcoming module, what I'll do is I'll either refer you to that particular module or webinar that's been recorded. If we've got some spare time, I'll try and cover it off the best that I can as well. It's also a good way just to make sure that you're using the available resources. So what does that mean? It means Eureka Report, Intelligent Investor, and the InvestSMART websites themselves. There's a lot of different tools on there that you could use, and it's great that you've got 1 month free to Eureka Report and to Intelligent Investor. So it's worthwhile making sure that you know that and where you can find that information. But always remember, this is just an introductory course. It's not something that is like a university course. It won't dive into complex theories or kind of algorithms or any kind of equations. It's just going to cover off the basics. But apart from that, let's have a look. So far, we've covered off in week 1. We'll just go back through. So it was the bedrock to, I guess, the whole course or investing itself, where we needed to have a plan. So that involved creating a goal, so knowing what to shoot for. In my case, I use the example of saving for a house deposit. Next step is that I need to know what the time frame is. So how much time do I have to achieve that, or am I giving myself a certain amount of time to reach that goal? In my case, I want to have a house deposit saved up within 3 years. So that time frame for me is, my time horizon is 3 years. The risk is the amount of risk that I am comfortable with. So you don't ever want to be in a situation where you're going backwards, particularly with a house deposit. After that 3 years, you want to be forward and actually have your investment increase in value. I'm fairly comfortable with risk. I'm not someone who will check my investment portfolio on a daily basis. I might check it maybe once every week, or even once every fortnight, sometimes once a month. It's a very long-term strategy, I realize, so I'm not going to stress myself out by hopping there each day and looking at each kind of up and down. But how do we actually go about this? Well, we look at diversification, which is spreading of risk. So basically, we're looking to spread our hard-earned cash, our investment, across different types of assets. And asset allocation talks about what kind of percentages to each area. So for me, I'm probably going to be falling into like a conservative category of investment. So a lot of my cash is going to be allocated to things like fixed income or perhaps more defensive type assets. Week 2, we looked at the different kinds of investment vehicles. So basically the things that you invest in when you've got your investment portfolio set up. We looked at shares and exchange traded funds. Now, They're very similar in that they both trade on an exchange like the ASX. They've got slightly different uses, and we ran through that and saw that the costs involved with either of those. We also looked at managed funds and managed portfolios and the difference between the two, and this is also covered off in the bootcamp content. We finished up with the more defensive type assets, which covers off cash and bonds such as government bonds. And remember, there's the opportunity that as we're going through, you're more than welcome to ask a question on the right-hand side, and I'll get that alert and I'll answer it as we cover off different areas. So basically, if I had to sum up, what do we know so far? Well, we know we need to have a plan. So we need to know where we're going and how we're going to get there. What we can use to actually complete or achieve that plan. In that case, what kind of investments might we look at? But we also need to be aware of the costs involved and the risks, because the costs will always drag you down. Every cent that comes out of your investment in terms of the cost is basically going to reduce your ability to compound return. And also the risks. You don't want to be putting your money into something that promises a high return, but it may not be suitable for you in the short term, and therefore can be more risky, and you could actually go backwards. So week 3 is the investment strategy. So it's how to go about using the different investment vehicles or investment choices that we've covered, in some ways in which you could best approach them. And we talk about active and passive, like the definitions, and give examples of both. The core and satellite strategy, a value investing strategy from a usually share investing perspective. Technical analysis is an interesting one, which we'll have a look at as well. And then we also cover off income and the income-based strategies that some people use as well. Market timing is an interesting discussion, and we'll have a look at that at the end of this one. So basically, with investments, you've got 2 different types. You've got active and passive. So passive investing, it's basically a way in which you can track an index and you're accepting the returns that it provides. So you're not trying to outperform the particular market. You're happy just to go along with the flow and get what it gets. So an example of that is the ASX 200. You could track that each year. So if you put some money in, it would go up or go down the same amount that that index would go up or down, less any costs, of course. So it's not trying to beat or outperform a particular target. Active, on the other hand, is basically making decisions that are different from, say, a passive type, such as an index, and you're looking to outperform. So you're looking to do better than what you could do just by putting your money into something passive or something that tracks an index. Usually they tend to be more expensive. There's usually performance fees involved, and there's a lot more, I guess, human thought or even brain power involved, which means higher costs as well. So a couple of examples here. We talk about the InvestSMART products just because they are our own products, and we, or I'm particularly familiar with these. There are others out there, so by no means think that this is the only thing you can invest in. Definitely do your own research and see if it's suitable to you. But we look at the example of a passive, and we've got the InvestSMART balanced portfolio there. And this is a diversified portfolio, so it's automatically spreading your investment, your cash. It spreads it across different kinds of assets that we can see there, and it invests into exchange traded funds. And what they're doing is they're basically tracking an underlying market or an underlying index itself. And a good example is for Australian equities, we invest in a ETF that is basically just going to track the ASX 200. So it's not trying to beat it. it's just going to get the same returns as it does, less any fees involved. On the other hand, you've got the active side. An intelligent investor, which does a lot of these stock recommendations and research, they have their own portfolios as well. So they've got one that's called the equity growth, and it's basically focusing on undervalued companies and investing in them with the hope that they increase in capital value. So you've got a team of researchers, of analysts behind the scenes on a daily basis doing research and seeing if the stocks that are made up of that portfolio are appropriate, or if there's any kind of potential or other investments that they should be looking out for. What I might do is I might jump to our website just to show you what I'm talking about. So on the investsmart.com.au website, you've got the Invest with Us. And if I click on that, it'll take me to the page where it shows us our diversified portfolios. And there's 4 off-the-shelf options. And you can see the time frames there, the name. So balance was what I was looking at before. If I click on Learn More, it'll take me to the section that breaks down a lot of the information that I need. So you can look at the product disclosure statement. That's very important. It'll have all the information that you need to make a investment decision. And then if I go down the page, I can get into things like the key details and allocation. And this will actually show us what it's holding inside. So what it actually owns or invests in on the ASX to get you this kind of allocation on the left-hand side. To compare, we've recently launched the Australian Equity Growth Fund. Now this trades on the ASX under the code IIGF. So if you have a brokerage account, say with CommSec or NabTrade or something similar, you can type in that code. It's a 4-letter code, so IIGF, and you'll actually see that you can buy this on the exchange. You can buy it at market. So as I mentioned, it's got its asset allocation in here as well. And that's currently has a indicative net asset value of $2.54, and the price to trade on the exchange will be slightly different as well. So with the InvestSMART diversified portfolios, they start off at $99 per year to manage. That's the fee to manage it. But as soon as you have $82,000 or above across our InvestSMART portfolios, they cap out. So you won't pay more than $451 per year. So that's a great way to keep the money in your pocket and get the benefit of the compound returns. The Intelligent Investor, it just charges a flat fee of 0.97%. And there's no other charges for establishment, contribution, exit fees, withdrawals. And that's an open fee. And that typically is reflective of the fact that it's an actively managed fund. So you've got a team of analysts out there picking and choosing what should go in there. And they're trying to outperform a certain target, which in this case, it's trying to beat the S&P ASX 200 accumulation index. So that's the top 200 shares by market capitalization, so their size. So you've got like Rio, BHP, Commonwealth Bank, etc. And accumulation is meaning that instead of the dividends coming out, they're actually added back in. So it takes into account if you were to reinvest any dividends paid out to you. So this growth fund is trying to beat that particular index. So when we talk about core and satellite, it's basically a melding of the 2 different strategies of passive and active. So at the core, at the center there, you've got a passive type approach where you might be invested in, say, those passive InvestSMART diversified funds that we were talking about just before. On the outer, you can have little satellites. You can have as many as you want. They have an active component. So for example, when we were listing the growth fund, that Intelligent Investor Growth Fund, I had a number of clients who were calling up and talking about how they had a passive investment at the core, which was, in our case, the ones I spoke to, it was the InvestSMART diversified portfolios. And they chose that something that was suitable for themselves. So someone who might have retirement a long way down the track, they might have chosen a high growth because it gave that time frame of 7 to 10 years. So they had that at their passive core area, and they've then also chosen what kind of split they want. So they might have 60% of all of their investment portfolio in that core, and then they've said, I'll allow myself the rest of it, the 40%, to sit in little satellites. So this one particular investor purchased the growth fund, but then he also had other ETFs on the active area as well that gave him exposure to other areas. And the satellite is all about trying to outperform, seeking alpha, they call it, and it's trying to do better than the market does. And that's not always the case. You can find that sometimes the best choice may have been just to follow the market, but there's always that potential that you're trying to deliver better than what you could do by just putting your money into something passive itself. So it's a quite a good approach. It's something that you should look into and see if it's suitable for yourself. We talk about it in the content on the bootcamp as well. So there's no questions as of yet, so I'll continue on. And we're looking at value investing now. So this is basically one way in which analysts or investors determine how to buy certain stocks, and they're looking for stocks that are priced way below their actual value, and they use a number of different ratios that we've written here: price to book, price earnings ratio, and dividend yield. The Intelligent Investor website has such a good summary that I'll be doing it an injustice if I try to, I guess, read out what's on here. But if you go to recommendations on the Intelligent Investor website, you can see value investing. So click on that and it will talk about what their strategy is, and it explains value investing here, and you can even click on it and get a more in-depth definition and explanation. But they talk about the pros and cons of it. They talk about, I guess, their ideology behind it. They're happy to wait if they do think that something is undervalued and represents value, which therefore represents growth and ultimately profit as well. They do talk about the different kinds of ratios that I was mentioning now, such as discounted value, so future value, the ratios here. They also talk about their recommendations. So they have a stock recommendation system here, and they explain what they mean when they talk about buying, holding, and selling, and also the prices here as well. So definitely, if you've got a chance, have a look at this section, and you can also see the recommendations at the top. You can go to latest, where we can break it down by buy, hold, sell. So the latest ones, for example, Gaurav updated one on the 15th, so that's this morning, and that was for Bapcor, so BAP. So he's saying it's a hold, and you can click onto that, and no doubt he has 3 minutes read, and he's written, I guess, his argument for his recommendation. So this part is quite interesting, and it does come back to even that active and passive satellite approach that we're talking about, where you might decide that part of your satellite is you just following recommendations from Intelligent Investor. So you could basically have the list of all the recommendations here, and you could be following it in your own brokerage account, and that would cover or make it a certain size of your overall portfolio, but it would definitely sit in that satellite as opposed to the core. So you wouldn't want to have all of it in there. You just want to have a little bit where you're trying to use the expertise and the knowledge of intelligent investor analysts to outperform. So you're trying to pick some diamonds in the rough. Technical analysis is another interesting concept. It basically is plotting prices onto a chart and then trying to find patterns or symbols. It does have some benefits in terms of looking at long-term trends. So you can definitely plot something and step back and see, okay, it definitely isn't an uptrend, or it's just going sideways, not much happening, or it's in a downtrend as well. It does have the ability to tap into our behavior. So as humans, we are designed to look for patterns in most things. Whether we look at clouds and we can see faces, we're actually just geared that way. So that can exploit that, where you can see patterns or even create them sometimes in order to validate your original thought process. So basically getting a chart to agree with your decision to buy or sell. Some of the strategies that are touted, they can sometimes be cyclical and will only work for certain periods. And what I mean by that is during a bull market, when the market's trending up, going up in value, you'll tend to find that a lot of strategies, particularly technical analysis, tend to do quite well. And the best, I guess, analogy or metaphor is that, you know, all boats rise with the tide. You sometimes need to step back and just be aware of some of the traders that are selling their technical analysis. And you usually see this in the form of a strategy or even a bot that will do this automatically for you. I'm quite skeptical of something that will do this. My experience, and I used to work at a broker where we dealt with a lot of traders. A lot of them that tended to take this kind of path, the majority didn't do too well financially. There's a website that I refer to called TradingView. I'll just, jump back here. And it's not affiliated with InvestSMART in any way. So definitely take that into account. It's a good way just to follow different indices or different graphs or different securities, such as, I mean, they've got the US election polls here as well, which is just interesting. But the indices, for example, here, so you've got the S&P 500, you could click on it and it will show me this particular chart. So I'm going to click on full feature just so I can see everything. I prefer the candles. So each candle here, and they call it a candle because it has like a wick, there's little lines above and below it, which are just indicating where the market opened, the highest point it got to, where it closed, and then also the lowest point it got to in that time frame. So each candle here represents 1 day, 1 day of trading. So we could look at this and we could go back to 23rd of March 2020, and you can see here that since that time, the S&P 500 futures has trended upwards on a daily basis. So people will draw trend lines, like support or resistance lines, and they might let it touch one of the candles. 2 touches is a confirmation, they call it. So they can make a decision then that when it does come back down, if we've drawn a line underneath it, let's see if I can quickly just draw one. I mean, I wouldn't think much about this particular trend line myself because it's only touched it way back in March, not done much with it at all. And then it's touching it again here in September. But some people might say that, okay, it's likely that if it touches here again, it could go up, or if it breaks through this, it'll keep going down. Now, that to me doesn't seem to hold too much weight. And sometimes you'll get people who'll go back and try and fit the lines to justify their decisions. So one of the things that this particular TradingView website does, it lets you go back in time. I believe it's this one. I'm going to sign in for it. What it does is it lets you go back in time so that you can go back to here and you won't have all this information, and you can try and work out, okay, so if I had been at this point, it's all I can see, just this backwards. It'll let you step through the upcoming prices or candles, and it's just a good way to see if your technical analysis works. So you should always do a lot of testing, back testing in particular, and yeah, be solid about that before you make any decisions. InvestSMART is more about the long term, diversified, and investing in, say, more liquid, so more tradable, more accessible assets. A lot of the people that I know who use the technical analysis, they tend to be very short term, so day trading type traders. Just had a question here from Brian asking, is TradingView free? It is free. As you probably saw, I had a lot of the pop-ups then myself, saying, you know, if you want to get rid of this ad, you can subscribe. You can pay a fee monthly to them, and they will give you some extra benefits. So check that out if you think that's interesting for yourself. It's not something that we're affiliated with, however, so I can't really tell you whether it's the best sort of thing to sign up for. I have used it for a long time. I just find it very interesting. It's good to see a graphical representation of, I guess, different securities or holdings or indices. I'm more of a graphical person myself. Numbers, I don't mind, but I like seeing them plotted out. So when we come to the dividend side of things, that falls under income. So when we talk about income, it's usually dividends, so profits that are paid out to investors, so paying out their share. There's interest income, so some of the things you might be invested in could be a term deposit or some kind of fixed income product, like a bond, government bond. They'll pay you interest. Sometimes you could be invested in, say, a toll road company or some kind of unlisted managed property fund, and they'll actually pay you rent, or they'll pay you tolls or even fees, and that's what we all classify as income. So how you view income, it really does depend on what stage of life you're in. All of us usually know income as being what is paid to us from an employer, or if we're our own, if we're self-employed, it's from the business that we're working in. But there's people out there who obviously have investments set up that it'll pay them side income. So if you're someone who's fairly young and you've got investments, typically the best way to use that income is to have it reinvested back into that investment so that it actually grows with the compound return. So I guess the benefit of that. However, if you're someone who's in the retirement phase, it may be more suitable that that income is paid out to you. And we'll have a quick look about the bucket strategy in the next slide. So it depends on what stage of life you're in. There's also, with dividends, there's franking credits that you can look at, which can be quite beneficial. That's something you should definitely do some research, particularly if you are in the later stage of your retirement phase, and always seek advice, particularly from an accountant or even a financial planner. That's very helpful. There are some articles on our website on the Eureka report that do cover off some of the basics of that, but getting advice can be quite helpful. This is the bucket strategy. So this is one strategy that was thought up in a way to try and help manage your investing, and consists of having 3 buckets that we can see there. And that first bucket is going to hold cash that's readily available for current living expenses, and that's for a period of 2 to 3 years. So the next bucket though is the cash flow bucket, and this is additional income from dividends and interest. And that's by investing in a diversified portfolio of investments with a balanced profile. So again, just using the InvestSMART product as a reference, that would be having a portfolio, say a balanced one there. And what you're doing is you're paying out the income into your current spending. So any kind of dividends or interest can get paid to, say, your bank account, and that'll help you with your living expenses over the next 2 or 3 years. The next bucket is the growth portfolio. So it's basically having, I guess, a bit of growth, a little bit of risk to get some return. And what it's saying there, it's saying you can get further yield and potential for capital gains. So that's the actual investment going up in value by using a diversified portfolio of investments with the growth profile. So again, if we were to go back to the InvestSMART products, that would be either a growth or a high growth type approach. So that's, in a way, it's a bit riskier, but it's also usually going to give you a higher return because it's more invested in investments such as shares, which themselves tend to generate fairly good capital returns and also provide some income. And particularly the InvestSMART ones, we invest in, say, the index itself. So we don't invest in just one share. We track the index. So any kind of amounts that come from that is going to top up your second cash flow bucket. So there is that kind of cascading effect where each bucket will top up the preceding one. It's an interesting strategy, this one. It can make it a little bit easier for a lot of people to follow just by having the idea of 3 different buckets. Ultimately, if you were to add them all into one bucket, you would end up with a kind of balanced portfolio anyway. So that's one way to look at it, but it does help a lot of people in terms of trying to visualize their investment portfolio. Market timing. So this is definitely another human problem that we have. And a lot of the InvestSMART products in particular try and, I guess, help with this and avoid it by just, you can invest it, have your time frame, have your goal in mind, know your risk, and then set it and leave it so you can walk away and let it grow and not have to worry about it because it's being managed by the team at InvestSMART. Inherently, we're terrible as humans in terms of choosing when to jump into a market or jump out. I've seen this myself numerous times, both working here at InvestSMART, but also at my previous job at a broker. There's a lot of people, even at the start of the year, who saw that the COVID pandemic was happening, and even though they might have been invested for a 7+ year time frame, they decided that they would close their portfolios at the bottom of the market. And obviously, we can't provide personal financial advice, so we can't sit there and say, don't do it because this will happen. We can't do that. We can provide general advice, and the general advice is that if you've got your goal, you know your time frame, and you're comfortable with your risk, well, then you should stick with it on that basis. There will be years in that 7 to 10 year time frame where there will be negative years. That's just how it is. But the positive years should outweigh those negative years. So what we have seen is some people jump out at the bottom and then decide to jump back in. And when they were asked, well, when are you going to jump back in? They said, oh, when the market starts going up. And the next question was, well, when will that happen? And they said, oh, I don't know. I just got to wait and watch. And that's the problem. Like, they don't know. The experts don't know. I have no clue, or had no clue, when it would start to retrace back to where it was. So ultimately, what a lot of investors did was that they managed to crystallize a loss. So they realized that loss. So they closed at the bottom and they bought back in probably even higher of where they got out. So all they managed to do was take a big chunk of their investment and realize it as a loss. It is difficult. It's not something that's easy. That's why what we say is you should always go back to your plan. And it comes back to even when you're planning it from the start, you do need to understand that if something bad did happen, are you prepared for it? And you can do certain techniques to try and mitigate this or reduce the risk of this happening by even doing negative visualization. So thinking, what is the worst that could happen and how would I handle it? So for some people, that might mean that they have to put aside more cash. That might make them feel more comfortable, or they might have other savings they can access in case they went backwards. So that also gives them a bit more reassurance as well. But it does come down to having the right plan, knowing your time frame, and understanding your risk. Dollar cost averaging is also another method. So the flip side of this is that we had a lot of people when the pandemic started, where the market was down, and they were calling us up saying, I want to get in. This is an opportunity where I can buy a lot of the investments at a discount. We won't see this again for a long time. I'm going to jump in. I've got a large amount of money. How can I start to do this without just plopping it all in at once and getting that day's price? So dollar cost averaging is one technique where you can split it up across a number of different payments or sizes. So say even if you had $1 million, which would be a great problem to have, you could split it up into 10 lots of 100,000 and then slowly trickle it into the market over a period of time. So you might buy something when the market's high on the Monday, then on the Tuesday it might be down, you buy it at a lower price, and so forth. So over that time period, it'll average out and you'll get an average entry price into that. So we had a question also from Tony, and he submitted this before the webinar started. And he's asking, what is the best way of identifying a good fund manager? It's a very good question. For me, I would probably have to come back to even what we offer at InvestSMART in terms of the funds that we offer, how we manage them. It's about providing a return that's reasonable for the amount of risk that you're wanting to take, but also the fees. The fees are such an important thing, and at InvestSMART, we go on about this quite a lot because our CEO, Ron Hodge, is quite passionate about it. He gets quite annoyed with the financial services industry about how for such a long time they just take and take and take, don't really provide too much sometimes, but then they just charge the world for it. He started this company with the belief and the vision that that's not the only way. You can offer a good investment and not have to charge outrageous fees. So he came up with one of the first products, maybe even the only product still available that caps out the fee. So basically what we're saying is that we can manage your investment, your funds, and we can provide returns that, well, here's an example. This is the InvestSMART balanced portfolio. Obviously we had that dip there when we've come into the pandemic. So that's our balanced portfolio there at the top. And then this is the average of our peers. So there's 566 peer funds that offer the same kind of investment portfolio. And you can see from the inception that gap in terms of us outperforming them has gotten wider and wider. And one of the key things is that we cap our fee compared to our peer funds. So they typically will charge you an open, uncapped fee. So as your investment gets bigger and bigger, you'll end up paying more and more to them. We don't do that. Our amount, our fees capped, and that money stays in your pocket. It stays in your investment. So that means that you get the benefit of compound returns, and it'll grow faster than something that's uncapped. You basically want the fund manager that you're going to choose to be quite open and transparent with what it provides, the fees that it's going to charge. You don't want to see any kind of hidden fees. You want to know the fees upfront. But at the same time, you also want to know that it's going to perform what it invests in. We basically do that ourselves by saying, these are the things that you're invested in. With the InvestSMART portfolios, you actually own the investments. So you actually own the underlying holdings. For example, if we look at the high growth, this is a managed portfolio. So we manage it for you on your behalf, but we go out there and purchase these holdings, which are ETFs, and they're all held under your name in a chess type account. So you get a HIN number, which means that something ever happened to us as the fund manager, your holdings are safe because they're in your name. So what I might do is I'll leave it there, and you can always contact us via email, which a lot of you have done, bootcamp@investsmart.com.au. You can also use the contact us button on the web page on the InvestSMART website, which you've probably seen, and that between the hours of 9 to 5 Sydney Melbourne time, there's a live person behind the scenes there that can answer any questions that you've got. Otherwise, as usual, tune into the weekly webinars and you can put your question ahead of time or ask it during the webinar itself. But until the next week's webinar, I'll leave it with you and have a lovely week.